So people ask me all the time, why don't we trade more? Well, here's the reason. If you'd have been fully invested over the last 20 years in the S&P 500, your return would have been between 9 and 10%. Had you been out of the market for just 10 days, the 10 best days of the market, your return is down 5 to 6%. What does that mean in real dollars? $10,000 20 years ago, fully invested, today would be around 70. If you missed the 10 days, that same $10,000 would only be $32,000. That is why you want to stay in the market with good companies and ride them up, ride them down, and then ride them up again.
Hey, what's going on, everybody? Welcome back to another episode of Wealth Defense Radio, the podcast, where today we are talking about the difference between owning a good stock and a good company. My name is Josh and I'm an independent advisor representative for Swan DFW. That stands for Sleep Well at Night, Dallas, Fort Worth. And across from me is the founder of Swan DFW.
12 years old.
12 years old. It's almost pubescent.
Pre-adolescent, we call it.
Yeah. This right here is Hector and Josh. He's a certified financial planner, which is the top mark in our industry. He has been doing this since the Dallas Cowboys were last perennial Super Bowl contenders.
So winners, 1993.
It's been a while.
We won a Super Bowl. Yeah, it's been a while. Yikes.
Yeah. So, well seasoned and experienced, we'll say.
And look so young.
Yes, of course.
That was what all of our followers were saying that.
Yes, for sure. So we are talking about the difference between owning a stock, or I guess the difference between a stock and a company.
Right.
Because that's a question we got from some of our clients. So the next several episodes of this are going to be going through and answering some of our clients' questions.
Yep.
But first, I have a question for you.
Sure.
As we record this, or I guess as you're watching this, the Winter Olympics have just started.
Really?
So which Winter Olympic sport do you think you could most competently do as you are right now with no training?
Climb a mountain. No, that's not a sport. It's an inside joke. Try to climb a mountain with no training. The first thing that flashed through my mind was it the luge, the one-man thing? You get in a sled and you come down really fast? Because I feel like all you got to do is just hold on and hope you don't die. Okay. I think I could do that well, maybe, or bail out in the first 10, 20 yards. Probably, I forget the name of it, where they push the little thing and they do the
curling.
I think I'd be an excellent curler.
Okay.
Is there like goaltender in curler?
There's not a goaltender.
I would have been a really good goaltender had there been.
Oh, okay. I think there's a place in Michigan you can go and try out luging.
Luging?
Yeah, that's where you just lay on the board. Is that the one you're talking about?
Yeah, and you just pray you don't die.
Yeah. I think the one I'd be most inclined to do would be bobsledding. I think that feels like in a group of 3 or 4.
Oh, yeah.
It feels like that would be hard to mess up. I feel like you push it off and you just
you're
ride
the middle
in the back.
Guy. The driver's the driver, the guy's the last guy. And and then you just pray not to die.
Yeah, for sure. For sure. People love looking at me in spandex.
Okay.
People upset. So back seamlessly to our topic. We're going to break down the difference between a stock and a company. Yeah. I guess the first thing that we should ask is what's the relationship between a stock and a company? Because they're kind of the same, but they are different. Yeah. So how are they related to each other?
Well, a company's the entity that makes and sells things, right? That's the driver that you got to have something that's making things and selling things and being profitable. Okay. A stock is a way to share ownership. That's where the word, a share of, share ownership with other people. And sometimes those shares are priced differently than how the company's doing. So all related to what the company's doing, but sometimes the share prices are unrelated to the price of the company.
Yeah, and sometimes the share prices or stock prices try to look forward at what the company is going to do. So this is not investment advice, but why don't you give some of the listeners or viewers like an actual company example to relate it to?
Well, the easiest one is Apple, right? They make a great phone. They make a great iMac. They make a great Apple Watch. So once you get into that ecosystem, even if somebody came along and said, hey, I got a great phone, way better than the Apple phone, everything I have talks to each other. So it'd be really hard for me not to be an Apple client anymore. And so we know that those people are going to be clients for a long time. They've got a great subscription business. It's a great company to own. But the stock price sometimes is different because the stock price is a lot of times based on how the investment world feels about the company. Does it feel like it's going to be more profitable in the years to come? Does it feel like it's in a position to grow its business because of whatever's happening in the in the financial world and in the investment world? And so sometimes you could have, and Apple is a good example sometimes, is the company doesn't change day to day, but the stock price can change a lot in a given day. The stock price has no effect on the company. Tomorrow, everybody's going to show up to work and they're going to make great phones and they're going to make great computers and they're going to make all this. But the stock price can fluctuate day to day, and so there's a relationship, but sometimes it's not entirely tied to the company. It's to how the investment world feels about that company.
Yeah, so if the stock price, as an example, hypothetically, if the stock price for Apple was to drop 20%, the company itself doesn't change. They're still going to wake up tomorrow and sell phones and iPads and watches and Macs and everything. Like, the company is still going to operate the same.
Yeah, if the stock price drops 20%, they're not going to lay off 20% of their people tomorrow. The company's going to be the company, and the stock price is going to be the stock price. And so that's why we want to own a great company, and we know that sometimes we're just going to have to sit through stock prices, some volatility in the stock price, but we know that down the road, this company is going to be much more profitable and have bigger market share, and that's what we're looking for.
Yeah. So I guess here's the question that people are going to have, investors, maybe people are trying to do it themselves, DIY their retirement. Why would I want to own a good company instead of like today's hot stock?
That's a great question. I think it's perspective. A day trader or even a stockbroker is in it for a very short period of time. And what they're trying to catch is that momentum stock, that stock that's going to be up in value today and maybe tomorrow. And they want to buy it early and they want to sell it later in the day and they want to lock in a profit. And they sometimes don't even know what the company does. They just know that the stock is hot, and they may not even know what's driving the stock to be hot, but it is hot. And one of the challenges with doing it that way is you have to be right twice. You have to be right when you get in, and then you got to be right when you get out. And so it's just a matter of perspective. The time frame that they're looking at. Day trading, by the way, is a really quick way of going, losing, if not all, a lot of your money. It's happened. I've heard of people doing that. We are looking for great companies that we know are solid stocks, but that stock price may fluctuate day to day, quarter to quarter. But we're pretty sure that 5 years from now, that company, one, is going to still be around, and two, is going to be bigger and more profitable than it is today. And so we would be rewarded for holding on to it. Our philosophy on some of these companies is buy them, own them, don't trade them. If we change our mind about a company, then we'll get out of it and we'll find another opportunity. But the companies we own are usually really good companies. They have really good balance sheets, that have really good management, and are in a really good part of our economy that we feel are going to grow. So
there you go. So if there's one thing that people should take away from this episode, What is it?
Yeah. I think the big thing is own great companies. You'll be rewarded for owning a great company. You may have to sit through some volatility, but that volatility comes from people that got into this. Some of these people that have a shorter term vision for what they're trying to do, and they get in and they ride it up. And once they recognize that it's topping out for that cycle, they'll get out. They're really not long-term investors. And once they start getting out, then the stock price will come down. The idea is you look at a chart of a company, you see the ups and downs are higher, the highs are higher, and the lows are higher. So it's trending long-term in a good direction. So you just have to buy a great company, make sure it's a great company, and then just stay invested in that company and you'll be fine.
Yeah. I would say, too, we're, like Hector said, we're longer term focused. This is like if you're planning for your retirement, right? You want good companies and not the flavor of the day.
That's
or
right.
Whatever. If we were to shorten down into one sentence.
That's it. Because it's way riskier trying to get in and out of the market all the time. It sounds like a simple thing to do. Well, just sell it when it's real high and just buy it when it's real low. Not many people make a living doing that.
Yep.
So
if you all want to talk to Hector and I about your retirement, we have a couple different ways that you can do that. The first way is via email address, and that is info@swandfw.net. Or we have a phone number, and that is 888-792-6339 or 888-SWAN-DFW.
brilliant.
So, thank you guys for listening.
Yeah. And give us a like and a thumbs up and ask us a question. It'll help our algorithm. Huh?
Yeah.
I got that right?
A word that Hector for sure knows.
And we'll get more people listening to this. So thank you again, and God bless.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.